use of common technology platform by all banks and circles of microfinance in the country. In Uganda precisely, we signed a contract with the Uganda Bankers Association, which is the body umbrella of all the banks, to provide a single
system, which was launched in April 2018 with just 2 banks participating, was a combined effort of many sector players, including the Bankers Association, the regulators and development partners.
We had key partners that came in from the onset, from the time the concept was developed in 2017. We had financial sector deepening Uganda, facilitating the training curriculum that was put in place through, again, MicroSafe that came in to be able to provide the training facilities. We had ABI Trust that came in especially with the devices to prove the concept to the members. We had GIZ, Financial Sector Deepening Africa, the Nairobi office. Bank of Uganda is a major stakeholder because they participate in facilitating the settlement of these transactions.
Partners.
We had key partners that came in from the onset, from the time the concept was developed in 2017. Majorly the financial institutions. We had financial development partners facilitating the training curriculum that was put in place.
The journey has been impressive.
Through, again,
participating banks' numbers have risen from 2 to 18 banks.
The number of agents grew from 1,200 to nearly 8,000, and transactions have
had ABI Trust that came in especially with the devices to prove the concept to the members. We had GIZ.
Good afternoon. Apologies, we are having slight technical challenges with the video that we are screening, and we should be back online in the next minute. Apologies for the delay. The next minute. Apologies for the delay.
In terms of value, we started with just 2.6 million. We're now talking about 2.5 trillion. Just this year, from January to June, the collections have stand at like 1.2 trillion.
Banking branches were largely concentrated in the urban centers, and that meant that we were hardly reaching a significant part of the population, and that constrained banking penetration quite a bit. So the coming of agent banking was highly welcomed.
It has been a well-received initiative by our customers, and as we speak now, following the introduction of the agent network, especially through the shared platform, we've seen almost 25% of our transactions going through that platform. We used to have many people in our banking halls.
The platform is ready. It has already been deployed. It has,
in terms of value, we started with just 2.6 million. We're now talking about
and therefore it is just an issue of
just this year, from January to June, the collections have stand at like
I am aware that the Uganda Bankers Association
banking branches were largely
creation of
concentrated
awareness,
in the urban
promotion
centers,
of the product,
and that meant
able
that
to
we were
onboard
hardly
agents and
reaching a
merchants
significant
across
part of this
the entire
population.
market.
And
COVID
that
has been a a good
constrained
lesson
banking
for everybody.
penetration.
I mean, it was not
So
anticipated.
the
Caught
coming
everybody
of
off guard.
agent
some of the
banking
things
was
that people have
highly
been forced to do
welcomed.
or not do.
It has been a
were happening for
well-received
the first time.
initiative
What
by our
happened with
customers,
the impact
and
that
as
we
we
had
speak
is
now,
that
following the
we were
introduction
just
of
starting the
the
journey
agent
of
network,
onboarding
especially
new
through
agents
the
and merchants.
shared
And obviously
platform,
with the
we've
government's
seen
restrictions and
almost
curfews being
25%
set up,
of our
we were literally almost grounded because that means
going
that
through
agents
that
could not open
platform.
shops.
We used to
as
have
well as
many
our field
people
officers who are
in our
recruiting new
banking
agents
halls.
could not go is ready and recruit. I would say that adoption of technology came in handy, that we were now being forced to use the existing and reach out to existing agents digitally. As I said, is opening digital account opening, allow paperless account opening. I think we have seen that happening in Kenya and some other countries like Rwanda, and now Tanzania has taken up. And that would mean that the traditional account opening requirements are actually being reduced, what we call minimum KYC. That opens up another opportunity for those that are not maybe very literate and use of digital biometrics for authentication instead of passwords are some of the additional ones that we have seen take up in other markets.
The shared agent banking system has enabled commercial banks in Uganda to reach far-flung areas efficiently and at lower costs.
There was a latent need of a pent-up demand for financial services in areas where the traditional financial institutions were either having a problem or did not find profitable to serve. As the financial sector regulator, we should focus on providing the broad policy and guidelines governing who can be an agent and what is expected of an agent. And then take those rules and give them to the financial institutions, who then use that as a guide in their recruitment and the placement and management of the agents. Their role in success is, you tell us as the participants in the agent banking ecosystem what it is you'd like to do, where it is you want agent banking to go. We work with you from a risk-based perspective to ensure that you get there, but in a manner that does not introduce systemic or non-systemic risk within the wider financial system.
Without the supervised financial institutions, then the shared agency banking proposition wouldn't be in place.
By 2017, commercial banks altogether had a total of 860 ATM points, serving a population of over 40 million. While this was insufficient to cater for all the customers, it did not make business sense to invest in this expensive platform. The Serbs responded to this need.
At that point in 2017, there were about 800 plus ATMs and 500 and something bank branches. And in comparison and contrast, there were 70,000 unique mobile money agents in the country. So there were 100 times or 100x more mobile money agents than there was bank penetration in the country. Today, because of FSD Uganda's initial grant support and technical assistance, we see around 7,800 bank agents in just less than 3 years since it first went to market.
We cannot continue to open branches each and every trading center. It is a costly affair. The technology cost, operational cost, everything is there. But under this model of agent banking, the number of agents spread across, when you look at Karamoja, customers can operate from TTB, Fort Portal, you name it, wherever it is. Or other banks' agent as partner agent for providing the service under the shared banking platform.
The shared platform has opened up opportunities to harness the economies of scale by fostering cohesion amongst the participating banks in a way that customers from the member banks can get served at any of the agent points. Agent banking has opened up opportunities to serve our customers at a lower cost while increasing our coverage and commitment to financially include the previously excluded. The model supplements our existing branch network as well as our digital banking capabilities.
Postbank, as a government bank, would like to drive digital agenda because we are going to change lives and livelihoods of people through agriculture. You need to reach out to the rural people and also maybe the semi-urban. And with that, the digital platforms really come in handy because one, they're efficient. Two, the brick and mortar cannot be in each and every region of the country. So the agency banking platform gives us an opportunity to reach to the far deep areas more so where we have most of our farmers and they are able to access the banking services without necessarily being there physically.
There are two major areas of benefit. From a duplication of cost point of view, a shared platform provides one central platform, so they don't have to invest heavily. But also, it enables their customers access services in areas perhaps where they may not have a presence. The second one is banking penetration by itself. Service centers were urban-based, and that means the rural people were not being reached and as such, not enjoying financial services. Today, we have 15.4 million accounts, coming from just under 7 million about six years ago. A lot of work has been done.
Besides creating a level playing field, shared agent banking has helped bring financial products and services to a wider and more diversified population, as well as provide choice. Ultimately, this has helped to deepen financial services and accelerate versatile payment ecosystem.
The biggest achievement really was that was made on day one, that launch day, developing the shared platform which hadn't been done anywhere in the region. That was very critical to demonstrate to the public that it is possible that a customer of Bank X could actually transact at another bank agent. When we launched with just cash in, cash out, and a bit of funds transfers. But as we went along, we kept developing new solutions, new services to enrich the platform. And we've been able to add critical ones like interbank funds transfers. You know, a customer is able to move money using their mobile phone from the comfort of their homes between banks.
The shared agent banking platform had support from several development partners like GIZ and ABI Trust, who saw this as an innovation for the financially underserved and excluded population.
In keeping with the mandate of ABI Finance in enhancing agribusiness lending and agribusiness development, we found it strategic to align ourselves with the matter of financial inclusion. Because the more we have a financially included society, the more the services that we wish to deploy agribusiness lending will reach the intended beneficiaries. So one key success factor that we're very proud of was a quick adoption. The second key success is enhanced financial inclusion. The third success is improved service delivery, where, as I mentioned, as part of financial inclusion, customers or beneficiaries or borrowers are able to do a little bit more than just deposit making. They're able to take loans. They've been able to access services such as insurance. And for us, agricultural insurance remains important.
Our aim is to improve the agro base of the rural economy in selected districts in northern Uganda. And you can't improve the agro base without the use of financial services. It is extremely important that out there in the rural areas, the communities, the people are able to, one, they can reduce the transaction costs, the time taken from whatever activities they are doing to and fro, and also to reduce the risks involved in carrying cash.
SABs have also proved to be a godsend for the mobile money agents. Most of the agents have rapidly adopted shared agent banking as an additional business, thereby increasing their revenue stream.
I've been in business for close to 3 years now, specifically agency banking. Particularly my business prior to agency banking, was mobile money. So it is in the interest of bringing this service closer to the people that I had to look around for agency banking. So because of ABC, agency banking, the platform that has enabled banks to share a single platform, you find like it has helped me get so many clients.
We established agency banking 2 years ago because it had futuristic ideas, in a sense that people used to come and use the clinic. Most of them used to say they can't pay because either the banks are closed or they can't access their money. But now their money is next door.
With a relatively young population and given their affinity to technology and innovation, the potential for shared agency banking in Uganda looks limitless. However, This success has not been without its challenges, with COVID-19 pandemic that led to a lockdown and slowing down of the economy hitting hard. But these challenges are in many ways also lessons to be taken into consideration for scale.
You know, in March, what happened was the country went into lockdown. And what that meant is there was no transportation, you couldn't, even though financial services was declared an essential service, agents still need to get to bank branches to deposit the float that they have, get electronic value, etc. It was just impossible. So agent transactions just fell down significantly. Their own agent revenues went down significantly. In a COVID environment, conversion of human behavior and pricing, because people can be very price sensitive, to digital platforms and to allow money to move without cashing out is something we need to consider for the future. For a temporary period during COVID, we had all bank to wallet, wallet to bank transactions being made free for a small amount of time. A shared platform is a long-term play. So it requires significant upfront investment from commercial banks and other players who want to ride on this platform. Till there is enough agent penetration across the country, enough reasons for people to continue using agents beyond just cash in and cash out, it will take time, and that is one of the biggest lessons learned.
Thank you. Thank you for that, Martin. We apologize for the technical challenges that we experienced airing the video, but we will be sure to share a link of the same in the chat box for your review in your spare time. I want to thank all our guests for joining us for this very important conversation today on the future of shared agent banking in Uganda and really beyond. A few housekeeping rules. All our guests have been muted on entry, so your video and your microphone have been muted, and we ask that you keep it that way unless you are a speaker or a panelist as part of the official program. We hope to have a very vibrant session today. We'll be discussing some learnings that are coming from FSD Uganda's case study on shared agent banking. And we really want to encourage you to use the chat function to share any questions that you have with the panelists and with the speakers. We will do our very best to ensure that as many of the questions as possible can be addressed during today's session. However, for the questions that we are not able to address, we will provide an email address and we are more than happy to engage with you further on them. So our program is expected to run until 5 p.m. We will start with a presentation on the context of shared agent banking in Uganda. We will then hear some comments from one of the key technical partners in SABS, Eclectics International, before we move into our panel discussion. Our panel is going to be moderated by the FSD Uganda Executive Director, Ms. Rashmi Pillai, and we want to take a moment to welcome and thank our esteemed panelists for joining us here today. We have Mr. Wilbrod Owor from the Uganda Bankers Association, the Executive Director. We have Mr. Paul Mbugwa, Founder and Group MD from Eclectics International. We have Mr. Makei Aumu, who is the Director at the National Payment Systems Department in the Bank of Uganda. We have Mr. Richard Yego, who is the CEO of the Agent Banking Company in Uganda. Welcome, Ms. Emma Mugisha, Executive Director and Head of Client Solutions at Stanbic Uganda. And finally, a very warm welcome to Mr. Edward Nkangi, who is the Executive Director of Pride Microfinance Limited. So we hope to have a very vibrant session, as I mentioned earlier. And we want to also acknowledge the following organizations whose input made the creation of the case study on shared agent banking in Uganda, Making Elephants Dance, possible. So we want to thank the Bank of Uganda for their input. We want to thank the Uganda Bankers Association and the Agent Banking Company for their facilitation and close partnership in finalizing the case study. We also want to acknowledge Eclectics International, the Agricultural Business Initiative, ABI, the German Development Agency, GIZ, Absa Bank Uganda, Diamond Trust Bank Uganda, Post Bank Uganda. We also recognize the efforts that have been put in by the FSD Uganda technical team, led by our Executive Director, Ms. Rashmi Pillai, and our Director of Programs, Mr. Joseph Lutwama. I'm now going to hand over the program to my colleague, Mr. George Muga, who is a market infrastructure specialist with FSD Uganda and who played a very key role in overseeing the FSD's contribution to shared agent banking and the production of the case study, which will form the basis of our discussion today. Thank you once again for joining us. And George, I'll now officially hand the program over to you. You're welcome.
Thank you very much, Diana, and good morning and good afternoon to everyone, wherever you are logging in from. And I'll take you through a snapshot, just a summary of the journey of shared agency banking system in Uganda, and also some of the learnings and a few of the challenges. And then we will take it over from there to hear some of the comments as well as the discussion from the panelists. So the shared agency banking system in Uganda, in terms of the genesis, started way back in 2016 when the FI Act, the Financial Institutions Act, was amended to allow commercial banks to be able to operationalize agency banking. And then in the year 2017, what followed after was the commencement of agent banking regulations as given by the Bank of Uganda or the regulator. Now, this helped the commercial banks to be able to roll out agency banking. Of course, there were some front runners in Uganda who started by rolling out proprietary agents in Uganda, and therefore there was the need to see how they can include or how you can bring together the other banks that are also operating in Uganda. Between July 2017 and around March 2018, the Uganda Bankers Association presented the concept to the Bank of Uganda, which is a shared platform. And the shared platform would then allow inclusivity of the commercial banks, irrespective of their level where they're actually playing or operating in Uganda. So a couple of activities took place there in terms of the procurement of a technical vendor or a technical partner. There was the development of the business case and the development of the solution itself, which also led to its testing. And then, of course, the training of the personnel, of course, from the banking side as well as on the potential agents. And that culminated then in the launch of the shared agency banking platform in April 2018 with two banks who had joined, or two banks who actually saw the need to be the front runners in joining the shared agency banking platform, that is Absa and Bank of Africa. Now, in terms of bringing out the concept and bringing out the story, the shared agency banking had a merit, and that's where the UBA actually came in to share this concept with the regulator. It meant to allow inclusivity and also bring a level playing field and creating efficiencies on expansion of banking services to the underbanked and even to the unbanked in Uganda. More importantly, also it offers a choice to the consumers and the players, and they will be able to then compete in terms of the product and services that they are offering. The guidelines, however, did not explicitly allow the shared agency banking platform. even though it just allowed for agency banking to be rolled out. Now, the concept was presented through support from technical assistance from FSD Uganda, as well as supported by CGAP, and also there were other partners like ABI Trust and GIZ, as my colleague Diana has mentioned. And it was important also to ensure that individual banking institutions, as and when they plug into the shared agency banking platform, they drive customer recruitment or customer onboarding and ensure that there is also uptake of their banking products and services through effective and efficient marketing and communication campaigns. So all in all, it was about the 4 C's for them to converge, to collaborate, and to compete at the same time. In terms of early learnings, especially in comparison to mobile money operations, the Bank of Uganda had mandated that the agents should have additional business in addition to running agency business. And these were some of the things that perhaps impeded on a rapid scale for agency banking in Uganda when compared to mobile money operations. But nevertheless, these are some of these factors or these particular rules are being discussed upon with the regulator. Some of them have already been overcome, whereas others are still being looked into. So also the potential agents who have been appointed need to be in the business for 1 year and also need to hold an account with a formal financial institution for at least 6 months. So what this means is that some ready and potential business entities may have to wait longer because their business is perhaps at infancy stage. It has not yet celebrated its first birthday. And also you find that, especially in the rural areas, some businesses do not hold accounts with formal financial institutions and therefore they are locked out. The other reason that impeded rapid scale was the fact that the micro deposit taking institutions, which are largely licensed as tier 3 institutions or supervised institutions, were not allowed to operate agency banking. But this has so far been allowed, and I know that some of them are already part of the shared agency banking platform, and they are going to also launch their services through a framework that has been guided by the Bank of Uganda. The Bank of Uganda, as well as a regulator, also needed to approve every single agent who is appointed or who is onboarded into the system. And it then means that there was a little bit of time lost there, but we believe that in the coming days, this has actually also been overcome and it will need lesser time for them to be approved. The other thing, especially when we look at the digital framework that we are now operating in, is that it required them to issue paper-based receipts to consumers as opposed to electronic receipts, especially when you compare with mobile money operations. So in a nutshell, these were just some of the reasons that perhaps impeded the scale, rapid scale for agency banking or the shared agency banking in Uganda. But like I said, some of them have already been overcome, and there is still a lot of discussions in terms of overcoming them. In terms of the key partners, my colleague Diana has also mentioned them. I'll just run through them a little. Uganda Bankers Association, of course, as an umbrella body, holding 51% on ABC, and ABC is a joint venture between Uganda Bankers Association and Eclectics, which is the technology provider, holding 49% equity shareholding. Then, of course, we have the Bank of Uganda as a regulator and supervisor of all financial institutions, played a key role in issuing the guidelines for agency management and also the activities that go around operating agency banking. We have GIZ and ABI Trust that supported communication and also in terms of marketing, as well as provision of point of sale devices for the agents and creating publicity and awareness. Financial Sector Deepening Uganda provided the technical assistance as a think and do institution, especially supporting them in formulating the appropriate business model, pricing, and even consensus building, as well as supporting the training or developing the curriculum for training for the bank agents, as well as for their personnel on ground. So in terms of achievements, what has happened since April 2018 to round about the time we are talking today, as at February 2021, this year, 19 commercial banks have joined the platform, have plugged in or integrated, and are actually operating on the shared agency banking platform, which means a customer belonging to Bank A can walk to an appointed agent of the shared agency banking platform and can do a transaction, which basically means that they can either, for example, deposit money into their bank account or deposit money into another customer's bank account, who belongs to another bank altogether. As of June 2020, that is last year, and according to ABI Trust, there are about over 8,900 jobs that have been created since the shared agency banking network was set up. And mainly this was through the hiring of agent staff, as well as other layers still within the value chain, because it's not just appointing of an agent, but it's also about who is operating that particular agency shop or agency kiosk, for example, and who are also the other secondary actors along that chain that are supporting the viability and the operations of that particular agent. At the beginning of last year as well, it was noted also that deposits, of course, were higher. That is people putting in cash, which is then reflected into their bank accounts. But it's also important to note that this dropped a little to around 75%, meaning that there's more money being derived from the network, meaning that as money is deposited into these accounts, then it means that there is revenue that is generated either from the accounts transacting with one another or with other accounts within other banks. And therefore, there is revenue that is being derived from there. It has also been reported from the Supervised Financial Institutions fraternity that there has been an increase in number of account holders, and also just in terms of general account customers that are transacting within the banking sector ecosystem. And also in terms of agents and customers spending more time on their businesses instead of spending time queuing in the banking halls, or losing time, especially when it comes to travel time to and from the banks. And this has also supported reduction of crowds, especially in cognizant of the COVID-19 pandemic and social distancing requirement as one of the SOPs by the Ministry of Health. But more importantly also is to pride ourselves with the fact that this is Africa's first interoperable bank agency network that has helped to deepen and broaden the reach of financial services to the unserved and the underserved. In terms of challenges, a few of the challenges that have been noted, and of course, these are also being overcome on a day-by-day basis. One is an appropriate pricing model that will suit all the players. Given that all the banks or many of the banks come in with their different propositions or their different business modeling, it is important to ensure that there is a pricing model that is appropriate and cuts across all the players within the shared agency banking, so that you don't have negative competition or competition as such being raised, and therefore creating an imbalance again within the ecosystem. In terms of product provision as well, the banks enable different available service options available, whereas many look towards, deposits or ensuring that deposits take place. It is also important for the banks to ensure that they provide other ancillary products and services that would then enrich the entire service provision for the customers that they have within their ecosystem. They have mentioned the issue of the rollout of the printed receipts, especially in comparison to mobile money. And in this age of the digital era, we are looking at ensuring that the receipts are actually digital in nature, so that it can also help to reduce the physical nature of issuing out receipts. And it's also costly at the end of the day, because the agents have to buy then the roll of paper on a regular basis, and to ensure that they don't run out of this. More importantly, again, is the creation of awareness or increasing awareness amongst customers, which is coupled with digital literacy. These two go hand in hand, because when you talk about, when you market your product, which is digital in nature, then both the facilitator, that is the agent, and the customer, both need to be aware and need to be literate when it comes to the digital aspect of the product itself. So the agent is the first point of contact with the customer. He or she needs to know how to perform a transaction or how to initiate a transaction. The customer himself or herself also needs to know how to also initiate the transaction from their side, especially if it is a cash out transaction, or to do any other product or service that is facilitated through the shared agency banking platform. Lastly, other challenge and also is about KYC verification. This is know your customer verification. More importantly, especially when it comes to onboarding of new customers, the struggle or the challenge there is how the agents are able to identify them and ensure that they can efficiently onboard them seamlessly. But this is something that, of course, is being worked on between the Bank of Uganda and the National Identification Regulatory Authority, as well as the supervised financial institutions, that is the banks, so that they are going to have a framework by enabling banks to identify customers on a seamless or on a real-time basis, so that there is no time lost between the time the customer is presenting themselves with an identification document and the time when the account is activated, not just activated, but also being able to do a transaction on that account. So with that, I come to the end of my presentation. I would like to then hand over to Mr. Paul Mbugua, who is a founder and group managing director for Eclectics International, to share some of the key highlights, especially as a partner from a technical perspective. Thank you and welcome to Mr. Paul Mbugua.
Paul, you're on mute.
Yes, my name is Paul Mbugua, as has been mentioned, and I'll be taking you through the lessons learned in the Uganda project. And here is my brief 2-3 slides on that. As I indicated, I'm Paul Mbugua, I'm the founder and group CEO of Eclectics International, a fintech that is operating in 25 countries and growing, 26 countries with 260 customers, corporate, those are banks and microfinance using our platform. And going straight to the project, Uganda has remained the first, I know there are many others that are coming up, the first country to roll out a shared platform that is geared towards financial inclusiveness in a common understanding. As my colleague has just mentioned, to collaborate and compete, but most importantly is achieve more. I just wanted to cover this slide in its entirety. As the technology partner of this project, the journey, as you can hear, was officially granted to us in 2018. we were asked to roll out a first ever project that even ourselves had never implemented. We analyzed the level and complexity of the project, and this is a summary of it, that we needed to implement because the partnership was on build, operate model. We had to implement a strong infrastructure that is going to withstand 24 banks and above. And that meant from the hardware, the connectivity and everything, because all of us in the past have been used to running a single bank with multiple branches. In this case, you have the entire banking industry together with their branches and therefore multiple connectivity and so on. We also had to connect, and we prepared ourselves to implement a system that is able to integrate with 24 core banking systems. Again, this is to be able to reach out the customer accounts for balances, fund transfer, bill payments, and so on. But moreover, as we thought that there is going to be a single tariff guide, along the way, it came out that we needed to implement a system that allows every bank to define their own tariff, because we appreciate different banks serve different market segments. We also needed to integrate with more than 15 card switches that have been, again, different vendors, different technologies across the world. We needed to implement these projects concurrently because different banks came at different times asking to activate specific components. That meant from our side, we needed to have multiple projects, a very able team to run different projects at different times for different complexities. We then needed to integrate with more than 100 third-party systems. And these are the billers, the telcos, among them, the email servers for every bank and so on. We needed to enable, to implement a system that allows multi-tiered agency hierarchy, from super, master, all the way to till level. We also needed to implement a system that is seamless, easy to deploy and easy to use, because the level of knowledge by the agents and the users, the customers that they find may not, because financial inclusion is bottom of the pyramid, may not be necessarily tech savvy or educated, we won't say. We were required to implement a system that would bypass or would be able to qualify or pass the comprehensive independent audits done by the banks and the audit firms, the big fours and so on in the world. We needed to comply with the regulator. And that does not only mean the central bank, but again, including international standards. We needed to deploy a system that requires us to guarantee 99% and above uptime. We needed to deploy a system that I've mentioned about multi-tiered agency. We needed to deploy 100+ real-time reports and dashboards that can be viewed across by different banks based on their appetite and based on their data insights. We needed to deploy a system that has complex security policies that would again pass all the individual banks standards. Remember again, majority of these banks or some of these banks are multinational. So we had to engage them independently, communication, and until we pass their policies. We had to deploy a system that runs on 9 different POSs, and those are the ones that are currently operational. We found that some of the banks had parks, some of the banks had, Ingenico, other have Verifone, so many terminals. And we built a system that can run on each of those POS terminals. Also take into account that tomorrow and the future, there will be different versions of the terminals and phones, because the system also operates on phones. We needed to deploy a system that is agile enough to continuous development on the go. We also needed, the expectation of our partnership is that Eclectis will deliver a system that has unlimited capabilities from banks, number of banks, because now you can hear, now we are going to have microfinance have been allowed, and tomorrow will be SACCOs,
and who knows, in future there'll be corporates. We needed to develop a system that can allow unlimited bank employee users and the administration of those. We needed to deploy a system that has unlimited terminals adaptability. We needed to deploy a system that can handle millions of transactions throughput. We needed to develop a system that can handle, as we can hear, the now 7 million, 20, 30 million customers in the near future. We needed to deploy a system that has not only continual development of features, but features that can be easily deployed within a short time. But what was also conflicting within all these requirements is that we needed to give a solution that is affordable to be able to achieve financial inclusion, since we know that the cost of banking is one of the limiting challenges in the banking sector. So you can imagine the situation of you need to have to balance the best of what you can offer, but again, it has to be affordable and long lasting. So that is what we say. The project was very complex, and we have been able to achieve that as Eclectics and obviously with the partners and banks that we serve. The responsibilities, there was a question about partnership and responsibilities. We split our partnership into two. UBA responsibility was business development. The other partners of banks and any other association, they report to the central bank and so on. And Eclectics by itself was provide technology. Well, that means the business development is onboarding customers, ensuring dispute resolutions, ensuring central bank reporting, and so on. On Eclectics side was deploy, maintain, support, upgrade, and ensure immediate, ease of use. And that marks to me the end of my presentation. And I'm ready for any questions as we go along. Thank you very much.
Thank you. Thank you for the very informative presentation, Mr. Mbugwa. That helps add to the context that was given during my colleague George Muga's presentation. And now we've come to what really is the heaviest part of today's agenda, which is our panel discussion, where panelists are going to reflect on some of the key learnings coming from the shared agent banking case study, as well as respond to some of the questions that are already coming in our chat box. So I want to remind all our participants and really encourage you, if you have any questions regarding the presentations and the submissions that are being made, kindly post them in the chat box. With that, I'll now welcome the FSD Uganda Executive Director, Ms. Rashmi Pillai, who will be moderating the panel session. And on the panel, we are going to have Mr. Makei Aomu, Director of the National Payment Systems Department at the Bank of Uganda, Mr. Richard Yego, the CEO of the Agent Banking Company of Uganda, Ms. Emma Mugisha, the Executive Director and Head of Client Solutions with Stanbic Uganda, and Mr. Edward Nkangi, who is the Executive Director of Pride Microfinance Limited. Thank you, and over to you, Rashmi.
Thank you, Diana. Can we have the videos of the panelists as well, just the panelists? Welcome, everyone. Good afternoon from Kampala. I'm excited to moderate this session. It promises to be very exciting. We are looking at more of a conversation style of a panel discussion. So panelists, you're welcome to, turn on your video, and let's also discuss in case you have a rebuttal to comments made by your co-panelists. You're welcome. You're also welcome to interrupt me so that we can keep this exciting and engaging for our viewers. So hang on, I'm trying to see whether I can see my panelists. Maybe if we could request you to stop sharing so that we can look at the Is there a way we can remove the slide sharing at the moment? Perfect. Excellent. Welcome, panelists. I'm excited to have you on board. Our first question is to the CEO of ABC, the Agent Banking Company, Richard. You know, we have several interesting questions from the chat. We also saw Paul and George walk us through the origins and the genesis of shared agent banking. We know that at the time that Uganda got its, the regulations were put in place as a function of the amendment to the Financial Institutions Act. The mobile money ecosystem is very mature. The banks needed to take a more innovative approach to deepening cash in, cash out penetration in the country. And if you remember, there were multiple aspects, Richard. There were the discussions around how do we increase, why should banks participate? What are the incentives? And some of the arguments were around efficiency. Some of the arguments were around cost savings. And I'm sure Emma we will come to her who will speak about that. Then we had discussions around agent viability. And the genesis was that interoperability, being able to serve customers of multiple banks should increase agent viability. That was the original idea. And then we had the goals of the country, which was the financial inclusion goals of the country, which is how do we increase cash in, cash out penetration, density of that in the country? How do we increase competition, choices for the customers? So these were there were multiple dimensions that were taken into account while designing this. Now, 3 years down the road, how close or how far are we from the original plan, from the original vision?
Thank you very much, Rashmi, and thanks to the entire team that has presented earlier on. And welcome, good afternoon and good evening and good morning, wherever you are, to our viewers. Yeah, so Rashmi, like you've mentioned, it's been quite a journey that has give and take probably taken us just over 3 years now since we launched. But when we look back in terms of what we set out to achieve and where are we at this time, I must say we still have a lot of work to do. We have barely scratched the surface to achieve in terms of where we want to get to. But in terms of percentage, I would say we are 70 to 75%. Yeah, we still have about 25% to cover, 25% to 30% in terms of achieving full interoperability. And when I talk of full interoperability, we're looking at interoperability for across all the entire agent network, the entire customer base of the banks. And when you look at, you visited some of the agents, you might find that there are certain, some of the members have activated cash in, they've not yet activated cash out. Some of the cash outs that are active using cards are not the mobile phone, and vice versa. So we still have quite a bit to do in terms of getting where we really want to get to, because the picture we are looking at is a customer should be able to walk into an agent and transact, whether they've forgotten their debit card, they should be able to use their phone to take out cash from their bank account. We are not yet there. To some extent, we've achieved that partially, where we have the cardless option of getting out money, but also the cards are not activated as much as possible. Like George mentioned, so far about 75% of the transactions are cash deposits. And this puts a lot of pressure on our members because this is a cost. Yes, money is coming in, but the agent needs to be paid a commission. Now, it is very critical that we activate revenue generating transactions for the members. So it is critical that we get the cash outs growing. Yeah, initially it was at about 95%. But in the past 3 years, it's come down, it's coming down slowly. And our target is to achieve a 60-40 or 55-45 ratio of cash in is always going to be the king. Cash in, even on the mobile money side, accounts for about 55%. But if we can get to the 60% percentage contribution from cash deposits, then I think we'll get there. But we are soon getting there. So 75% is where I can say we've reached so far. Rashmi.
So Richard, you made some very interesting comments there. So for the benefit of the audience, just if you could give some numbers, how many agents are live? How many agents does the shared agent banking platform have? How many are active? What are the number of transactions we are talking about, like what the volume of transactions we are talking. That's part one, so that the audience can appreciate the journey that we have achieved so far. And the second thing is, you mentioned something interesting, which is that the revenue or model for a lot of the members does rest heavily on cash out. But is it fair? Now, the question, especially to you, is that you came from a mobile money background, right? So you understand the agent banking, you understand how mobile money agents work versus the bank agents. Given that the nation is looking at a digital economy, which means we want to reduce cash-based transactions, is that model still the right approach? Richard, you're frozen. I'm hoping you were able to hear my question. I think we lost Richard there. Emma, while Richard is coming in, welcome. As the Executive Director of Stanbic and one of the big players on the shared agent banking platform, maybe you could take the second part of that question, Emma. Are you as Stanbic looking at cash out as one of the big revenue drivers, especially when we're talking about a digital economy, talking about how people can continue to use digital financial services and moving from cash to digital? Is that how you're thinking about, still think about agent banking?
Actually, my view is completely different. I'd like for ABC to become a proper switch where we can actually switch between banks and MNOs digitally and reduce the amount of cash, because what we've done is we've moved the cash away from our banking halls to the agents. But what would be the more efficient way would be to get out of cash completely. So we're saving some money now by pushing the transaction to the agent, but ultimately where we want to go would be to a more digital experience where the system actually becomes a switch that we can seamlessly switch between banks, switch between MNOs and banks, and we can do it from the comfort of our homes as opposed to having to look for an agent. So taking it on a tangent, I guess.
So what then happens to the agents? How do they, how are all, because UBA and the banks that are part of UBA own 51% of this company. So as one of the shareholders of this company, what happens to the agency business as we look at, so are we thinking of the agency business as a transitionary arrangement till we become more digital? What could you just speak to that a little bit?
It is a growing new business, I would say, business area. And for as long as we are cash economy, it will play a big part. And I can say, for example, for Stanbic, 33% of our transactions are actually going through the agent. So very important partner for us right now. Most of our transactions are going there. It's just that in the planning for the future, the question is, shall we continue to be a cash economy, or shall we start to trend towards digitization? That's, for me, was the question I was trying to get to.
That's very fair. Emma, I'm going to now push you slightly on the financial inclusion piece. I wouldn't be doing my job if I didn't. What happened with most of the banks, as we know, is that they first used, not all of them, many of them used agent banking first as a cost reduction strategy. So the bank branches that were non-performing, the banks obviously very rationally said, we can still have presence at a much reduced cost, because having a full branch is like about $100,000. So now the question is, are we seeing that step one was cost reduction, but are we also seeing banks now saying, let's also use agent banking to not serve just existing clients, but use it as a bigger retail acquisition strategy? What's the thinking there? That's question one for you. And the second one is Stanbic took a very different approach compared to some of the banks. You have your own agents, which are proprietary just for Stanbic, and then you have shared agents. So if you can tell us what the strategy, the thinking behind, I think the audience would appreciate that.
Okay. So we need to get beyond cash in and cash out for the agents. We need to get other services going. And where I'd like to start that from is also what is the value proposition of the agent? What is a successful agency business? What kind of services should it be providing to its customer, who in this case is the bank or the bank customer? What other services can they provide in order to be more profitable, in order for the agency business to grow beyond cash in and cash out? And what we're looking at is obviously customer acquisition. We're also looking at some financial literacy work, because the agent is in the community. The agent is closer to our customer than we are. So are there some modules on financial literacy that the agent can actually undertake to do on our behalf, and we can then pay the agent for that? I think that becomes the second level of agency banking, such that even if the cash in, cash out reduces, the agent is still relevant in the economy. So we need to move to other services. And I think a big one is really acquisition of customers. So that's one. Your second question is, yes, as Stanbic, we started out on agency banking in 2018 with our own agents. And the reason for that really was that this was a new phenomena. We're trying to get to understand how do we manage these agents, how do we train them, how do we empower them to actually build our brand in the community. So we started out with our own agents, and then later joined ABC. We joined ABC last year on the issuing side, and this year on the acquiring side. And what that did is immediately doubled, actually tripled our agency network in one day. So from a financial inclusion perspective, from a closeness to our customer, joining ABC has helped us to get closer to our customers, given our customer a lot more choice in terms of where they want to do their banking. Also, the other thing we've seen is that the agency business in itself is growing. So we're not looking at the agents just as points of representation, but there are customers also in terms of the agency business and banking the agency business. So that is also something we're looking at and growing and supporting them from a working capital perspective, because you find that they're toggling their money between MTN, Airtel, Stanbic, Centenary. So there's this float that keeps being toggled around, and it's never enough. So they're always, trying to make up depending on where the demand is. So that's also a growing piece of the relationship that we have.
Thank you so much, Emma. Mr. Director McKay, now we're coming to you. So as George mentioned, welcome back, Richard. I will circle back to you. We missed you for some parts, but I will come back to you in a bit. Director McKay, so we heard George gave his presentation. We know that originally the central bank, the design of agent banking was new. There was a more conservative approach, but the bank was progressive in allowing for shared agent banking to kick off, and gave a no objection to the Uganda Bankers Association and Athletics to set up an independent company, ABC. Could you also highlight some of the challenges that George raised in his presentation? One of them was around the fact that deposit-taking microfinance institutions cannot directly do agency business. So they are today serving their customers in partnership with commercial banks. It would be, and if you look at it from a financial inclusion perspective, these are the institutions that are serving or were originally designed to serve the rural economy. So if you could shed some light on why that was the design originally. And we are aware that the central bank is relooking at some of these aspects. So if this is something that will be considered as a change in the future. So that's one question. And then there's the other piece, the other challenge that George mentioned in his presentation, which is that how do we get to a point? What do we need to do to get to a point as the same degree of penetration as mobile money agents? How do we make it a competitive playing field? So those are the two questions to you, Director McKay. Sorry, Director McKay, you're on mute. You're still on mute.
I hope you all hear me. I
Yes.
hope I'm audible. Okay, good. Yeah, thank you, Rashmi, and I want to greet all the stakeholders, all the participants in this webinar, and all the listeners. And I'll straight go to the question that you've asked me to answer. And I think I'll begin by walking you through some kind of journey. And the journey is that it's about test and learn. And this was not something completely new to the central bank, because way back in 2009, we were approached by MTN to offer mobile financial services. And the answer was that you're not a financial institution, so we need to go into partnership with the supervised financial institution. And so we saw Stanbic partnering with MTN, and subsequently we had 6 partnerships where the central bank offered no objection. And all through the back of our minds, learning from mobile money financial services, we knew that agent banking model would accelerate financial inclusion in the country. However, we were aware that there were some setbacks, some constraints. So one of them was the limitations of the law, because the law did not allow the more of agent banking because of an issue of having a branch, physical branch, and of course, which had the all expensive brick and mortar, capital expenses, and all others. The other issue was the issue of non-exclusivity. So indeed, in 2016, we had to amend the Financial Institutions Act to allow supervised financial institutions to take on agents, to be able to recruit agents. And in 2017, the regulations were final. And indeed, our dream of the agent banking model came true. And when the UBA came in, and of course, we know that there were already some banks which came to the center forward. That included Equity and Centenary Bank and Stanbic, but there were still issues of non-exclusivity. So indeed, the shared agent banking platform came to fill this gap of non-exclusivity in 2018. But you see, it's like where we had Airtel and MTN originally erecting masts side by side. Now, in agent banking, we see a shared platform which allows for interoperability. Over and above this, the central bank offered to ABC connectivity to the RTGS system, and so that the settlement of transactions as well as revenue sharing could be facilitated. So what the next question I think is about the lessons learned, challenges. To us, it was a dream come for financial inclusion, more or less like what mobile money is doing. But we note that these are very high value transactions, bigger than the average mobile transactions. And we see that now by turnover, we're seeing like 1 million transactions, 1.4 million in a month. So this is really to expectations. But of course, we still have challenges which Richard walked through. One of them is the requirements for recruiting agents, that they have to be having some other business, they have to have some kind of incorporation. This was meant to allow in players who already have some kind of business experience, who can manage risks associated with handling money. But we have indeed seen that some of these requirements need to be amended. And indeed, we are in transit to amend the banking regulations We also note that MDIs cannot participate, although they can be sponsored by members in the supervised financial institutions. So we also, this MDI Act is also being amended to address this challenge. We also note issues of broadband, poor network connectivity. We did a midterm review of the National Financial Inclusion Strategy, and these are some of the challenges that we see. We also see still challenges of non-exclusivity, but getting better by the day. And we also see that there's a need to increase on the use cases, because we note 75% is deposits. But we should be an avenue to help open bank accounts and all the other issues. And we think that these are the things that need to be added on. In terms of the National Financial Inclusion Strategy, recall we had 5 pillars. One of them was access. Access was a challenge because of distance or there being no branch. So agent banking has greatly filled this issue of distance and also issue of presence of a bank branch. So this is something which is moving in the right direction. Credit infrastructure, maybe not so much, because currently we're mainly on the deposit side, cash in, cash out. But indirectly, this could also be true, because when you have deposits coming in, some of this go to service the loans. So indirectly, there's a trickle-in effect on the credit side. We wanted digital platforms for efficiency. This is exactly what the shared agent banking platform is doing, and we're doing well here. As noted that the deposits are 75%, so deepening savings is something which seems to be working. And I think Richard indicated, or the earlier panelists, that we see growth in bank accounts. We also see growth in physical deposits. And we look at this also as a point of disseminating information to the bottom of the pyramid, because as they come to do their normal day-to-day, the agents are able to pass some information to them, which is very useful. So, well, in terms of what else would be added, I've talked about account opening, at least initiating the process of opening an account, initiating the credit processes. It should be a point where you should also be able maybe to inquire about your balance or get a minimum, know about get an account statement. And indeed, our dream here is in financial inclusion, but also achieving it through increased interoperability and the non-exclusivity. We think this will drive down the costs and make business, financial services more competitive. I think let me stop here. I have been audible enough, and I got my message, I hope. Thank you.
Yes, thank you. Thank you, Director McKay.
Thank you, Rashmi.
Director McKay, one additional question to you. So you said that at the end of the day, the central bank is interested in financial inclusion, but you're also interested in making financial services competitive. And that, when we talk about competition, that directly speaks to business models. One of the constraints that George identified in his presentation was the fact that the regulations state that agents should give paper receipts, which then invariably mandated POS machines. And these point of sale machines are ranged from $300 to $500. And there are today, agents can initiate transactions through applications on their mobile phone. But because of how the regulations were designed, it became a bank-led agent model, became very CapEx heavy. Do you think we will see some of those changes in the upcoming regulations so that customers can benefit from more agile and low-cost financial inclusion models and financial delivery? Mr. McKay? Hello? You are still on mute. Mr. McKay, you're on mute back. Sorry, we're not able to hear you.
Indeed, like I mentioned, okay. Like I mentioned, what we did following the midterm review of the National Financial Inclusion Strategy, we got a feedback on all these challenges of regulations, infrastructure, issues of digital financial literacy, and head on we have developed a matrix, an action matrix, internally, things that need to be done at the Bank of Uganda, but also externally, things that need to be done with the stakeholders. And so reviewing reviewing the regulations, making them more relevant is something that we already started. I talked about amending the agent banking regulations. I also talked about the MDI Act and many other amendments. And even now, as I speak, actually, I'm in Entebbe in a workshop. You know, we passed the National Payment Systems Act and the implementing regulations. So here we have a team from Minister of Justice, Minister of Finance, Bank of Uganda, our legal technical team, and we're reviewing comprehensively all the regulations and the provisions of the law to clarify areas that need to be done, and if there are areas that need to be reviewed, we are taking that into account. So indeed, our approach is now continuous engagement with the stakeholders. We have that engagement through UBA, but now we also have the fintechs, and we have the CEO forum for the institutions that have given licenses under the National Payment Systems Act. Through this engagement, we get direct feedback of some of the challenges that are there, and we promptly move in to see how they can be addressed. So the approach we have taken is getting closer to stakeholders, and also having an organized way of responding to the challenges within the central banks, especially where we need to amend the regulations. Because it's in all our interest to promote e-payments in this country and to reduce the use of cash. So this is going to be a continuous process and continuous engagement. That's how I can answer it. Thank you.
Thank you, Mr. McKay.
Thank you, Rashmi.
Thank you, Mr. McKay. Now we're going to Edward Nkangi, the Executive Director of Pride. Edward, I'm hoping you can hear me.
Very well, Rashmi.
Okay. So the first question to you, in response to Director McKay's, the central bank is considering some of the issues that George raised, which particularly pertains to Pride. Does this give you confidence that we're in the right direction? That's the first question. Second, right now, when we talk about how, can you tell us how you are delivering agent banking services to your customers? What is the structure of the arrangement that you have currently? And how does it impact the customer? In terms of like having too many parties in the equation definitely comes with its costs. So your responses there would be appreciated.
Thank you so much, Rashmi, and good afternoon, everyone on call. The first question is about the confidence, whether what McKay raises kind of presents some confidence to us in the delivery of just banking to our clients. This has been a story. This has been a discussion for some time. When we were starting, the first discussion was about exemption. For MDIs to be exempted, to get an exemption, to offer agency banking, much as the law does not allow us. That was the initial discussion. And at some point, we more or less got an assurance that this would be done. We were very happy. But along the way, as we're moving, I think that was kind of dropped. And then we started a discussion of the sponsor bank, working with the sponsor bank to make sure that we deliver what we are supposed to deliver. And as we speak, that's where the discussion is. But the third one, and what we think is going to be the best option, is the issue of amending the MDI Act to make sure that we are allowed as MDIs to do this directly as opposed to being super agents of the tier one banks, the tier one financial institutions. For people on this call, we realize that people have been following this for some time, that the MDI Act, the amendment has taken quite some time. It's close to, I think, 10 years. We are looking at amending this act. We are hopeful that possibly this time around, we shall get a breakthrough such that we do what we are supposed to do. Currently, the other question is how are we serving our clients? What we are doing is working as super agents through another bank. That's exactly what we are doing. We see it is the only avenue as we speak today. But our appeal definitely is if the MDI Act can be amended to allow us to agent banking directly. Remember, we serve the people at the bottom of the pyramid, yet we cannot set up brick and mortar everywhere that we are. So if that can be done, I think that is the best that we are all working and waiting for. Rashmi, I think.
Edward, for the purpose of the audience, can you explain, that not everybody's familiar with the term super agent. So can you explain to the audience, if in an ideal situation, if you are allowed to do agent banking versus what is happening today, what is the difference for the audience that is present here?
Okay, I think we can start with the simple things. Today, if you went to any agent in any location, you'd be able to see Stanbic, you'd be able to see Equity Bank, you'd be able to see Centenary, and other financial institutions. They are clearly spelled out, and they are there. Now, an MDI, because you're not allowed to directly work to directly offer agent banking, you need to identify a bank which is allowed to do it directly. Either Centenary Bank, Stanbic, DTB, whichever the bank, and sign up with them to be working through them. You need to open up an account with them, with that bank, and whatever you do must go through the process of that bank. So your clients are coming, but when they go to the agent, they work with them. Now, when I say super agent, our pride locations today, wherever we are agents of a bank. So we are serving our clients wherever we are as agents so I do not have to go through another kiosk. But the smaller kiosk can, for example, come through Pride as not as super agents, but as agents. But as Pride, I'm a super agent. So in essence, my location, my brick and mortar, in essence, is an agent to a bank. I don't know whether that kind of clarifies it.
Sure. Thank you, Edward. Could you also speak to the implications of this roundabout, for the lack of a better word, it's a roundabout arrangement that MDIs had to take because the regulation was not favorable. What are the implications on your customers? Are there any cost implications, financial inclusion implications? Can you speak to that?
Okay, indeed there are financial implications and issues of financial inclusion. For any institution like Pride, you'd want to go direct to your clients out there. Whereas we are in many parts of the country, would love to reach as many as possible without setting up physical locations, what I would call the brick and mortar. Now, in terms of expense, this kind of cobweb presents costs in between. So for you to be an agent or super agent, like we all know, there are costs involved because you're not doing the business directly. Now, in terms of financial inclusion, whereas I would have loved to go out there in Chiruhura, I would have loved to go out there deep in Mukono, in Buikwe, and have an agent, identifying with Pride directly, the way it identifies with other institutions. That for now is not what is happening. So when the client is coming, they are not looking at Pride. They are looking at this agent and they're looking at these posts and the kind of branding that is happening there. So I do not go out directly in terms of clients accessing Pride, but I need to go through some other person. It limits me in a way. Remember, Pride is one of those institutions that are serving the people at the bottom of the pyramid. I want to have my people served in all areas of the country where I cannot set up branches. This is a limitation because I cannot do agent banking. Yet, this is what one of the things that we think are going to create that financial inclusion arrangement. Yeah.
Thank you, Edward. Richard, circling back to you. You've heard Director McKay, Emma, and Edward, relay their points of view. One of the things that the case study mentions is that the SABS platform today has about 10,000 plus agents, around 62% of them are active. You can tell us what the latest numbers are on that. But the other pieces that everyone on the panel has mentioned is that most of the transactions are deposits, and they can be direct deposit into your own account, deposits for school fee payments, deposits for statutory payments like NSSF, URA, etc. But what people are also observing is that a lot of these transactions are agent-assisted transactions. People are coming to agents to do these transactions. But if we want to achieve what Director McKay said, which is e-payments, we need to graduate people from agent-assisted transactions to actually doing the transactions in the comfort of their home, as Emma mentioned. So can you speak to these elements a little bit?
Thank you very much, Rashmi. Thank you, Edward, Emma, my fellow panelists. Apologies, I got disconnected earlier. It really hit us hard last year during the lockdown, like you mentioned earlier, and in George's presentation, agents were not able to even access their outlets, yeah, and that therefore meant that we needed to give customers services that they're able to carry out without necessarily requiring the assistance of an agent, and that speaks to services like person-to-person transfers, services like cashless payments at the merchant points. We were telling customers, we should be avoiding holding currency notes because this could have been one of the medium within which the virus could be spread. So we do have a service within the platform. So far, we've activated it for 5 members out of the 21 institutions that are connected. And this is really the P2P, what would be your funds transfer service between banks. We are saying that all banked customers should be able to move funds between their bank accounts and other bank accounts, either within the same bank or outside the bank. The other one is the merchant solution. Merchant payments is another key deliverable that we are soon rolling out, which is really to help customers be able to make cashless payments when they're purchasing their goods and services across all merchant outlets. This is another big initiative that we believe will go a long way in deepening, first of all, enhancing the bouquet of services that the share platform should be able to offer. So imagine we had a P2P that was running smoothly. The damage would have been controlled in a way. And of course, this involves the convenience of a customer being able to move money, send money back home, send money back to the village, to their loved ones who are in need, especially the fact that movement could be curtailed. So for us, the way we're looking at it, two major solutions. It's the P2P and then the merchant payments that would be enabled through the mobile again. Because we know today in the market we have card payments, but the number of card payments is still very low in this market, and even card payments require that you have a POS machine. But the merchant payments solution we're looking at does not even require a device. All will require is the merchant to have their code. All the customer requires to key in the merchant code and then be able to make their payment using their mobile phone. We have over 28 million phones, so the mobile is the way to go. There's no doubt about that. And as we enhance the platform, we are cognizant of adding solutions like those, the customers more value across the board, not just for one bank, but for all the members that are connected to this share platform. Over to you, Rashmi. Thank you.
So Richard, as you were talking about the shared platform, one of the questions that many people on the chat are asking is the role of the agents. How are we and when you dropped off, Emma was talking about how agents could not only can be used for actually bringing more people into the banking ecosystem. So the agents become the the first point of contact with customers when they collect all of their onboarding documentation. They can also provide literacy and information. Are you seeing that, or what is happening with whose responsibility is it? Because the agent has been acquired by one bank, but the agent is serving multiple customers of multiple banks. Do you see any points of friction with that approach?
Yeah, so Rashmi, yes, one of the functions that the agents play is customer education about the services that banks offer, because the agent is the representative of the bank in that locality. And therefore, the customer has all the trust that this agent is, number one, well-versed. They are very much aware of the services that the banks offer. And the expectation is that the agents are well equipped with information regarding most of the services that the banks offer. So what is very critical that we've tried to do is training the agents, driving that awareness. In March this year, we're able to train agents across the country, again, in close collaboration with all our members. And we're able to pick up a lot of insights from the agents in terms of product awareness, not just cash in and the cash out. What other services? What is clear out there is that the agents are operating for, because there's no exclusivity, the agents are operating for 3, 4, 5 institutions. And therefore, they have a relationship with each of those 5 institutions. And what we see is that each of the institutions, whenever of course, they have the field teams that visit these agents to really speak to them about what the bank is doing, what is being delivered, what is being planned for each of the banks. So of course, the agents get overwhelmed in a way, because if you're receiving 5 different bank employees from different banks coming to speak to you about their products, then it becomes a bit difficult for the agent to keep all that information within them, and then therefore disseminate it. So it's one of the challenges that we have to work on to ensure that that there's no clash, because the fact remains, because the regulation says there's no exclusivity, then each of the banks is actually free to approach an agent and deliver a terminal to the agent. But what we are working towards really is to ensure that we eliminate duplication. Because today, if you walk to and this duplication started, of course, from way back in November 2017, when the first banks went into the market. The shared platform was launched about 5 months after 4 banks had already gone out to the market. So it was bound to happen that that agents are to hold several devices. Now, the perfect picture we're looking at is getting to a point, and we're getting there very soon, where an agent requires just one device. We are saying if we have full interoperability, which we're speaking about. Why is interoperability there? We went for it because we want to avoid duplication, reduce the cost of doing business, because as the agent holds several devices, they pay for them. Some banks may offer them for free initially, but it's not sustainable. So the agents, certainly what we're looking at is the agent just holding one device that should do everything. Because if we've loaded 21 institutions on the same device, then the agent technically requires one device to serve all the customers of the 21 banks. So the point that we are looking towards getting is where we basically sensitize the agent to tell them that, you know what, you actually require one device, unless you have several tills within your shop. But otherwise, one device should service you comfortably. You just need one float account and then one machine. And therefore, what do we do with the other machines? We should be able to redistribute them to new agents who are coming up, because these devices cost quite a bit of money. And so this is the kind of efficiency that we are looking towards delivering at the agent point. And of course, the branding, you've seen the branding, it's cluttered. We have you'll find about 7 branding materials at the agent outlet. That's not what we want to achieve. What we want to achieve is a unified branding material that has all the logos of these banks that are participating. And this should give a picture to the customer that, okay, I can actually get a service at this agent point. But behind this agent, there is one bank that takes care of that agent. I think that we will be able to work smarter and disseminate uniform information to this agent, where we get to a point where one agent is serving all the institutions using one device. And then we're able to scale much faster and move these extra devices to new agents, because sometimes we struggle to give new agents devices because the funds may not be readily available. So I think, like I mentioned, there's quite a bit that we have to do. Those challenges are real in the market, and we're working towards ironing them out. Rashmi.
Thank you, Richard. That was very comprehensive and such important comments. I'm just going to share my screen. Please confirm that you can see the slide that I'm sharing. Richard, panelists, can you see the slide that I'm sharing at the moment?
Yeah, sure.
Yes, we can.
Yes, we can.
Yes, we can see.
So if you can look at the map, and this is a question to all the panelists, and Richard, please correct us if the information is not right. You will see that most of the bank agents, this is a map of the concentration of bank agents in Uganda. Most 50% of them are concentrated in the central region. If you look at the north, it's 6%. Depending on which side of the north you're looking, here it's only 3%. The east, one section is 6%, the second section is 8%. So we have big white spaces. Banks are still predominantly serving areas that are already very well served. So Richard gave his views on what we can do to increase cash in, cash out, the density of agent access. Maybe Emma and Edward, you and Director McKay, you can also come in here. How do we rectify this map? How do we change the distribution?
Maybe I can jump in there. I think it goes back to financial inclusion. How do we get our people to under their mindset, trust the financial? There's a lot of economic activity going on in the north. There's a lot of farming. There's a lot of agricultural activity. So it's not like there's no money there. I think the money is there. It's just that we need to get our communities to trust the financial system But also, our friend from the MDIs, also Edward said, I think there are those areas that are actually served by the MDIs. How do we have an integrated financial system such that everybody is actually represented? I think in that way you see more of those points out there. So two things: one is to get people to trust the financial system more, but also how do we integrate the financial system a lot more so that those transactions that are cash-based can also come into the financial system.
So Emma, just to push on that point, the map was on agent existence, right? Where the big white spaces in the map. So question one is, A, are banks not required agents in those areas? Or B, are agents not signing up? Because one of the fundamentals of agent liquidity is such an important issue of agent, and there are not enough points for liquidity and rebalancing of cash and float. So why is it that we are seeing this big discrepancy? Are banks not interested in acquiring or figuring out liquidity models for these agents? Sorry to put you on the spot, Emma, but maybe I'll put Edward next on the spot.
No worries. I guess I have the largest branch network, so I should know. So if you look at some of those places you will find that one branch serves, say, 4 districts. And therefore, for some of those districts, actually the rebalancing is a problem. So we need to also rethink the model to have a lot more, maybe super agent kind of model where a bigger agent can serve smaller agents and therefore help with that rebalancing. So agents are just not signing up. You put out a request because you know you've got, say, teachers in a certain district, and it would be better if there was an agent in that district. But you find that they don't have enough volume to keep that business going, and as such, they will not sign up for the business. So you find that the branches up country do not get as many requests. What we've been doing late is trying to encourage SACCOs to become agents, because they are serving they're serving those people that would like to bring into the financial sector. So how do we grow the SACCOs such that they can be able to be agents and actually serve to the end mile that the banks and other financial institutions.
Edward, before Director McKay comes in, what is your take? What can we do to increase the density of agents? A majority of the
Okay, I think the starting point we need to appreciate is that the agents are also following the money. Where the money is, the agents will come in. Now, when you look at the central region, I think this is where we have activities that require daily transactions, activities that require money flowing in and out on a daily basis. That's where somebody's trading, and that's where money is coming today. And in a day, they are making those lots of money, because agents also are following the money. It's a business for them. And that is very, very important. But I think one of the key points here is we need to follow up on the people, on the institutions, on the SACCO, on the MDIs that are in the rural areas. If they become agents, I think it will be a lot more easier to have that distribution skewed towards the rural areas, towards the upcountry regions, because they will provide the liquidity in those places. It is common knowledge for us to go in those areas upcountry, and people are requesting for this kind of money in terms of amount, and the agents cannot afford it because of the lots of amounts. But if we have financial institutions out there becoming agents, if you have the MDIs and the SACCOs becoming agents, for certain, for sure, we shall see that distribution getting outside and serving the local communities as well. That's my take.
Thank you, Edward. Richard, will come to you. Director McKay, is this concerning with the central bank, and what does this mean for our collective financial inclusion goals, that there are so many spaces on the map that just don't have any agents?
Yeah, thank you, Rashmi. I hope you all can hear me.
Yes.
I'll start with the comments from Emma, which I think I agree with her to the extent that most of these areas are areas that have more presence of MDIs or tier 3 institutions. And indeed, as Emma indicated, there's a lot of economic activity in the north. And some of those areas where you have presence less than 10%. So I think, like I indicated earlier, from the regulatory side, we should step up and push for the amendments which are already in pipeline. Internally in the bank, we have an action matrix to make sure that these are delivered in terms of the become outcomes and reality between this month and December. But of course, issues of amending regulations and laws, sometimes they don't move as fast as one would want them to. But that's one. Two is the issue of, I've talked about the MDI Act, then the amendments, the requirements for recruiting agents. So the further you go away from Kampala, the more it becomes difficult, like to even register business or to have those official registration requirements. And so most of these businesses do not even have basic requirements, maybe even a trading license at minimum. So to me, the solution will come from amending the laws, the pending amendments, but it should also come from financial literacy. And talking about financial literacy, in our action matrix, we're also looking at what we can do together, collectively, like joint awareness. I think this would help. So I think this will be key to covering the gap. But Rashmi, I'm so grateful for the map. I hope you'll share it with us. And from our side, we are out doing awareness, spread throughout the country. And we want to ask them some of those questions as part of the awareness program. It's a very good map, I think, which one would want to have. But like I said, the bank's approach now is continuous engagement with the different participants in the financial sector, so that we see what we need to do as BOU and what we need to do together with the stakeholders. Thank you very much.
Thank you, Director McKay. And actually, this is Richard's map. We'd be happy to share it. But the ABC team has GPS coordinates of all agents, so they should be able to share that. And Richard, you can correct me if I'm wrong, that you will be able to share it with the central bank.
That's correct, Rashmi. We'll share with McKay.
Okay, so we are coming to the close of the panel, but it would be, I would be remiss if we don't touch upon two very important aspects, but we will keep this to the point. And those two important aspects are customer experience and consumer protection. And so Richard, we'll begin with you first. And I will kickstart with consumer protection. We've had fraud-related issues, cyber resilience. This is not all on SABS, but generally as an industry as a whole. How are we, what are the issues around consumer protection that you are seeing or keeps you awake at night? And how can we work collectively as the financial sector to address these issues?
Thank you very much, Rashmi. So this being a new channel, a new delivery channel for the banking industry, we've been in business for about 3 years, and you'll agree with me that awareness levels are still quite low, and that requires that we come out handy to educate the customers in terms of, first of all, what do we need to do to the customer to trust an agent? Because at the beginning of this, the rollout of this channel, we could see customers actually bypassing agents and walking into the banking hall. and simply because they were not sure that their money would actually get into their account by using an agent. So what that spoke to is really the need to push, drive awareness, and this could happen through the radio, through below the line engagements, where activations are done in the markets themselves, for the customers to really see and appreciate that this is actually a branch of banking that I can trust, I can rely on to carry out my transactions. So part of it, and when you look through the regulations, it's very important for the customer to build confidence that actually they are carrying out a transaction to the right account. And as a regulatory requirement, validation of these accounts that customers are trying to carry out transactions on happens. This happens online because we wanted to eliminate the element where some agents would receive funds from the customer and then tell them, oh, the system is still down. Once it gets back on, I will deposit for the money. It is very clear in the regulations that a transaction should not be carried out when the system is off. Yeah, transactions must be carried out in online mode. And this is what we have ensured that we do to see to it that when a customer walks into an agent, number one is the customer should know what the charges are. So to give the customer assurance that they will not be charged anything extra for the transaction they're carrying out, all charges are done within the system. The customer's bank account will be charged within the system, and they do not have to give extra cash to an agent to be able to carry out the transaction. So we are very keen on protecting the rights of the customer, but also the information of this customer, because we ensure that, first of all, within the platform, the fact that we integrate with all the institutions, it is very critical that we do not hold customer balances within this platform. So there again, the customer has assurance that it is only their bank that has that information. Biodata of the customer stays with the bank. All the transaction fees, like I mentioned, they have to be displayed at the agent outlet. The details of agent, the agent code has to be within the outlet. Agent is not able to carry out a transaction when they are moving, when they are mobile. So we ensured that we locked the GPS coordinates of an agent to a particular location that they specified when they applied to become an agent. All these initiatives are aimed at really protecting the customer from any unscrupulous activity that would happen, because it's very important that we give confidence to the customer out there that their bank is next door, their bank is in their neighborhood, and therefore through the training of the agents again and all the staff that manage these agents, we are able to equip the agents with the do's and the don'ts as highlighted in the regulations. Again, that is our Bible in our attempt to roll out these services to the customers ultimately. Yeah, so yeah, we, of course, in terms of account opening, Make mentioned it's one of the initiatives that we are trying to finalize to ensure that account opening can happen across the agent network, because this again speaks to the challenge you mentioned, why are agents scarce in rural areas. Someone mentioned, I think Edward mentioned that the agents are looking for where the money is. Now, we all know that the majority of customers are within Central Region. It means we've not penetrated the rural areas. There are some customers who are there, but we still need to do a lot. Emma talked about the circles. Those are potential agents and super agents. Now, those circles can actually operate as mini branches, because the fact is branches are scarce in the deeper urban rural areas and peri-urban. I'll just give you an example. There's a town called Konakamdin on your way to Gulu. It's a junction of Gulu and Lira. Now, that place has only one bank branch, Opportunity Bank. but we also found about 3 agents, but the agents are not for opportunity. So the question was, where are you getting float from? And they are saying it is a big challenge. They have to either go to Gulu, 70 kilometers upwards, or to the east in Lira, another 70 kilometers. So that's a real problem. Then we said, but look here, Opportunity Bank is on the share platform. So we have brought interoperability even on float, access to float, because we are telling them, actually, you can walk to Opportunity and get float. Any bank branch that exists in any part of this country is a source of float for all the agents. So we are saying a bank does not need to have a branch in a particular town to have agents there, but the agents of other banks that are in the neighborhood
Richard, we're losing you. Unless it's my internet. Sorry. Sorry, Diana, can you confirm that you can hear Richard? We can move
the
to
super agents. This is that will be about and where to. Okay, can you hear me now, Rashmi?
Yeah, sorry, Richard. We will have to wrap up because we're coming close.
Thank you, Rashmi.
Thank you, Richard. Emma, Richard, raised some very important points, but he also evaded my question. What keeps you up awake at night when we discuss consumer protection, when we talk about fraud? And obviously, innovations come with their own risks. How do we take risk-based approaches? So Emma, in brief.
Well, what keeps me awake at night is we are in an environment that is very wrought with fraud and with money laundering, and we have to be ahead of these issues. As we innovate, as we get more digital, as transactions increase in number and velocity, if we are not awake, there's some really big numbers can pass through the system. So again, we need to do velocity checks. We need to know our agents. We need to monitor. We need to have a system that is risk-based, and we can use the data that we get to manage risk. So working together, build our systems to be resilient from a risk perspective is very key for us. Thank you, Rashmi.
Edward, over to you. We understand that you're still working nice, but when it comes to consumer protection, maybe not fraud, maybe you can speak about consumer protection. What are some of the challenges? What keeps you awake?
Rashmi, can you just repeat that? I think there was some noise.
Sure. If you're not speaking, please do pause. There's background noise. Edward, hopefully you can hear me now.
Yes, I can.
When we know that MDIs are working through sponsor banks, right?
Yes,
so,
that's true.
Given what you are experiencing right now, what are some of the consumer protection issues that keep you awake at night?
Okay. Like I said in the beginning, every financial institution would want to get to their customer directly for purposes of customer engagement, for purposes of sorting out their issues directly, as opposed to going through another institution. It's challenging as we speak now that we are different levels. We are tiered FIs at different levels of maturity technologically. So if I'm going to solve a problem, there are instances where I need to go through a sponsor to sort out my challenge. Yet at the end of the day, the client knows pride, as an example. They would wish to engage me directly on everything that they do for purposes of sorting out their problems. And that in itself is restrictive considering that every financial institution is treated differently. The bigger players definitely would wish to have prioritized access. But if I'm there and I'm working and I have access to my clients, then it is best that I serve my client directly as opposed to going through another party. But very importantly, the issue of access and financial inclusion. It's a big challenge for me not to be able to financially include all the people I would have loved to, because I can't, the fact that I cannot do agency banking. But we are working on the hope, like my lecturer Makaya said, that the MDI Act will be reviewed and everything will be working as fast. Thank you so much, Rashmi.
Thank you, Edward. Director McKay, final word from you. The central bank has a considerable focus on consumer protection. Any lessons learned from the shared agent banking or just agent banking in general that you will look to improve when it comes to consumer protection in the future?
Yeah, thank you. I hope you can all hear me.
Yes.
The Rashmi, consumer protection is a big one. And even when we rolled the National Payment Systems Act, it's one of the regulations that was not finalized. And I'm happy to tell you that today at Entebbe, we have finalized the consumer protection regulations to support the National Payment Systems Act. But the lessons from shared agent banking competition that we need to emphasize, one is the issue of fair competition, which is linked to the issue of non-exclusivity. Our wish going forward is that the lessons from agent banking can be replicated to the whole financial sector so that we reach a point when we have another bigger shared platform, which we may call a centralized switch this time. We may call it a national switch. Our wish is that our customers or the members of public should be able to walk to an agent and get served. Similarly, our wish is that any member of public should be able to walk to an ATM machine of any other bank and get served without thinking of costs, without thinking of risks of security of the system, risks of failed transactions. So this is something which is keeping us on our toes. And we're working tirelessly to make sure that we have a centralized system. I know we're getting a lot of support from FSDU. We thank you for all the efforts that you're putting in, because we believe that when we have centralized systems, then we enjoy economies of scale, we get more numbers, and when we have more numbers, the costs should come down. And when the costs come down, everyone should benefit. I'm happy to note that when we benchmark with countries like Malawi, Malawi now has like one card which works, a unified card working in all ATMs of different banks, near uniform costs. The same thing is in India, to the extent that the rupee card is at the same level even with the Visa and MasterCard for local transactions. So our wish is really to have a centralized system to empower consumers through digital awareness, financial literacy, to trust these systems, to continue to emphasize non-exclusivity, ultimately looking for fair competition. I hope we get there one day. I think that's what, but we're indeed, like I said, we're already amending the laws. We're in collaborative arrangements with the stakeholders. We wish to have use cases of shared banking platform increased. I know that when it started in Kenya, Equity Bank offered points of sale and smartphones. Maybe we should be talking about infrastructure, whether we're their development partners who can help us, or the banks. We already have a system of sharing revenues. I think we can also have a system of sharing costs. Thank you, Rashmi, and I want to thank my student, Edward. You disclosed. Yeah, I recall Edward was my student at the university. I'm happy to have been in this discussion with you. Thank you very much.
Thank you. Thank you.
Thank you, Director McKay, and thank you to all the panelists. This was such an engaging discussion. Over to you, Diana, for Q&A and then the closing.
Thank you. Thank you for that, Rashmi, and thank you to all the panelists for a very engaging panel discussion. I'm now going to hand over the program back to my colleague, George Muga, who is FSD Uganda's market infrastructure specialist. We have been curating some of the questions that they have been coming in on the chat, and we'll try to address as many of them as possible. For the questions that we are not able to touch on because of time, we will certainly leave our contacts in the chat box for further engagement. So George, over to you.
Thank you, Diana. It has been indeed a really enriching conversation, and there are quite a number of questions that participants have put on the chat box. So we may not be able to go through all of them, but some have been answered in the discussions, but I've picked a few that maybe the panelists would actually be able to answer. So I'll start with Emma, and then to Paul, and then Richard in that order. So I'll just mention all the questions first, so that at least you can give a minute for answering them. So starting with Emma, so that I'm very gender sensitive, I like the fact that you've mentioned that risk is evolving on a daily basis. It keeps you awake. There was a question around providing microinsurance packages for agents in case they lose something. I don't know if maybe Stanbic is thinking about or around that, especially now that you also have agents participating within the shared agency banking system. And then to Paul, I know Paul has been very quiet from the last time he spoke on his presentation. There's a question around integration into the shared agency banking platform. Does a bank need to tweak their core banking system in order for them to plug into that? For Edward, it's about, as a microfinance institution, especially now that you're thinking of plugging into or integrating into the shared agency banking platform, have you done an assessment of the infrastructural costs to operate agency banking? Because that area seems to be an area of heavy lifting from a CapEx perspective. And for Richard, which I think you'll bear most of the questions, and I know you are a man of very many words, so you may have to think of how to reduce the answers maybe into short statements. One is about the channel of transaction. Have you thought about the application of USSD versus the point of sale machines? Instead of using point of sale, can customers and agents be facilitated to use USSD, given that perhaps everybody has a mobile phone? And then there's also a question touching on some players within the shared agency banking platform charging deposits for customers, and what does this imply in the long run? There's also a question around onboarding of customers. I believe that this is allowed as long as the participant's financial institution has activated that feature. How should this be simplified for the agent in terms of onboarding customers at the agent point? And then there's also a question around the business case by the agents in the rural areas, given that potentially the transaction volumes are very low. So is it ideally viable for an agent to venture into this kind of business? And also lastly, what about the interplay between mobile network providers and network challenges that may have also been experienced in the past, and how are you looking into that in the medium to long term? So those are the questions that we've been able to at least pick from the panelists, from the participants, and I would like then for them to start over Emma, and then to Edward, and then Paul, and then lastly, Richard. Thank you.
Thank you, George. I'll definitely take away the insurance question. I couldn't answer it offhand. There must be a package that can be put together. We've been insured as banks from our banking halls, so there must be a way that can also be put together. So I'll take that away and ask our insurance team to look at it.
Thank you very much, Emma. Edward, the question on assessment of infrastructure as you think about joining the shared agency banking platform.
Thank you so much, George. Indeed, these are things that we've thought about. I know it is something that is that must be ongoing, because you might think that you have it all, but at the end of the day, a few things come across. But one of the major ones, or two things that are key for us, is the core banking system. If you look at Pride as an institution, as an MDI, for some of us who appreciate Pride is a big institution. I can assure you that as we speak today, Pride can beat a number of even the tier 1 institutions along a number of things, including portfolio, including profitability, and a few others. Even the core banking system we use is robust enough to handle a number of things as they come along, a number of new financial services as they come along the way. I think the other one in terms of assessment is the risk, which is key for us. And indeed, these are some of the things we've looked at. I can assure you we can comfortably do this, but where we have challenges, definitely solutions can be sought. Thank you so much.
Thank you very much, Mr. Edward Mkangi. Paul, in terms of integration, do the banks need to change their core banking system?
George, please allow me answer that. Paul has stepped out, but I should be comfortable answering that. So the banks do not change anything on their core banking system. We have APIs that are available, and what most of the banks have done is probably have a middleware that we plug onto. So there are no changes required on the core banking systems on the side of the bank.
Thank you, Richard. So maybe you could take over the other questions. I hope you got all of them.
I was able to pick, I think, 3 or 4. You may have to read them for me. And whichever I've left out, let me answer the ones that I was able to pick up, and then you'll highlight what I left out. So there was one on the business case for the rural agents. Yes, indeed, the rural areas have a limited number of customers, and this ties into the second question of account opening. So it is important that the account opening feature is activated by our members to be able to get more customers in those areas, to then make the business case sell for the agent, because the agent will say there are no customers, who am I going to serve? So with the account opening, we're able to target customers who are actually using mobile money to also open wallets or bank accounts. So that's one of the areas we're looking at, activating opening across the board for all the members to take advantage of it, and then get agents, more customers onboarded to then give transactions to the agents, because that is very critical. Yeah, that's the other bit there. I will also speak about the insurance element, which Emma had requested to pass. I would like to update that as an industry, we have crafted a very good initiative. It's an insurance solution for agents, which we are rolling out on 1st October. We already have approval from Insurance Authority. We are going to cover agents, all the bank agents across the country, up to the tune of 200 million in terms of loss. So this is very good, and in turn, the agent will be able to pay a premium a certain percentage of their commission as premium on monthly basis. So it means when an agent doesn't work, then that month they're not covered because they will not have been charged the premium. So it's a very welcome initiative, which agents have been asking for whenever we interacted with them. And this is something that we are very excited to deliver to the agents. And good enough, we had consulted them and they have a buy-in. So the insurance solution that we have taken, of course, is being championed by the largest insurance broker, Minet, and then a couple of insurance companies. So we are happy to note that this is a pain point that we have managed to take care of going forward. And then the other one, George, I want to be as brief as you said. The other one is, you talked, I think someone talked about the MNO networks. I think that is to do with internet. Yes. MNOs are very critical partners in this ecosystem. All the POS machines, all the smartphones in the market are operating on APN cards, access point name cards. These are data cards, and these data cards are supplied by the telecoms. So telecoms are our critical. Without their infrastructure, then we're certainly going to have a low level of service or a poor quality of service. Now, what is very critical is the broadband. We are looking at, because agent banking is operating on broadband. So areas that have 2G coverage, certainly will not enable us to do agent banking because internet speeds on 2G are very, very slow. We are operating on 3G and Can you mute Samuel, please? Yes, thank you. So I was saying that the telcos, and we are very happy that government, there's a broadband policy I think that was rolled out in 2019, that was approved, that requires the telco operators to cover the entire country with broadband, which is 3G and 4G internet. We are not expecting to see any more 2G sites, and actually Airtel has already closed that. By 2020, all Airtel sites were 3G and 4G. I believe MTN should also be soon almost done with covering the country with 3G, and this speaks to internet being provided across the country, including rural areas, because now then that allows us to roll out agents in those areas. And so far, there's been quite a lot of work that has been done, again, through our collaborations with UCC, that then ensures that this is implemented, given that they are the regulator for the telecom companies. So we connect to banks also through internet. So the connectivity that we have, again, is dependent on the internet service providers, who could be actually telecoms. Some of them are just ISPs. So as we get into the rural areas, we are also cognizant of the areas that are covered by full broadband. And this is the good news is that most of the areas so far have been covered by internet broadband. Someone else talked about USSD. The platform is already facilitating USSD transactions. I'll explain. If a customer, today a bank customer is able to walk into an agent and initiate a cash withdrawal using their phone, using USSD. So the customer is able to dial the bank's USSD code for mobile banking and initiate a cash withdrawal. That a token is generated, which is given to an agent who keys it then on the POS device. But so from the customer angle, USSD is already working. But when it comes to the agent, the question could be, can the agent also use USSD? Now, the regulations, as you're aware, require that every transaction is printed. That's number one. Now, USSD will not enable printing of a receipt, because remember, customers are very keen. They want receipts. Even if you're sending the message, the receipt electronically, some of them still believe the receipt needs to be there, because they believe in seeing something, working with a piece of paper, which anyway will get lost. But USSD is already enabled on the platform. It's just that from the agent perspective, they need to use a device that, number one of the reasons we use the POS machine is for the cards. How will the customer use their debit card to cash out? because very few customers are actually tech savvy with mobile banking. When you look at the number of customers carrying cards and those using mobile banking, the cards are much more in terms of percentage. So we will have locked out card users in the market by not using POS devices, because we need a device that can facilitate a card transaction. Yeah, so that's another reason that we have to use POS devices. The smartphones are there as well with the Bluetooth printers that attach to them. Those are happy, those are working. And for the smartphones, we'll have to have a PIN pad then. So you imagine a customer is an agent operating 3 devices at the same time. You know, he has a smartphone, he has the PIN pad, he has the Bluetooth printer. Managing all those devices becomes more cumbersome compared to a POS device. So, but of course, we are working closely with Bank of Uganda to allow for the electronic receipts by way of SMS, because on the regulations, they still exist. George, could you mention the rest? Those are the ones that are taken.
I think, yes, I think you've answered all the questions, Richard. So I thank you very much. As my colleague that Diana had mentioned.
How are you? Put this thing on charge.
They can email on the email addresses that have been provided on the chat box to either FSD Uganda or to Richard Diego at Agent Banking Company Limited. So I want to hand over back to Diana for the closure part of the program of this webinar. Thank you very much.
Thank you. Thank you for that, George. And thank you, our panelists, for a very engaging session and for answering all the questions that have come through from the guests quite exhaustively. Now, we are coming to the last part of our program, and it's quite a critical part of the agenda, where the Executive Director of the Uganda Bankers Association, Mr. Wilbrod Owor, will wrap up the session for us and talk us through the industry's commitment to grow and enhance SABS going forward. So Mr. Owor, over to you.
Thank you very much. Can you hear me?
Yes, we can.
Okay. Good afternoon. It's been a very long but very, very rich discussion. I've been following it all through. So first of all, to thank you, FSD, and thank all the resource persons who have participated in the conversation, particularly the panelists and the rich questions. So I have to make this short. Since 2:30, I'm sure many of you are tired as well. So let me start by saying thank you. It has been a journey from 2017, August, when the concept of a shared platform, we first started discussing it, coming to a business case, identifying a tech partner, raising funds, developing and deploying the solution, launching. And today in February, perhaps Richard didn't tell you, ABC has broken even. So it's been a journey. There are 21 banks now. He's working on connecting Equity Bank so that by October we have 22. It's been a long journey, a lot of help from our partners, yourselves, ABI, GIZ, who have sponsored, awareness across the rural areas. Just the handshake logo alone says a lot, and I want to thank our teams here at UBA, Patricia, and the marketing teams, and even the staff of ABC who started from scratch, leaving their jobs in other banks and telecos to come and see this journey. I congratulate you. I thank Bank of Uganda for the support up to where ABC is now as the first shared platform across. I think there's still a lot of work, and the discussion has covered the challenges, the opportunities, the learnings that have come across. Again, I thank the panel for some of the constraints and limitations. And I had Nkanji at Pride, share some of the frustrations currently, particularly the fact that the other tiers are currently constrained, the MDIs. So what we have done recently, when the Bank of Uganda, in addition to the arrangements they have been putting to change the Act, we saw an opportunity recently when Bank of Uganda proposed revised capital requirements, paid up capital. And we've had a discussion with the Executive Director Supervision, a lengthy one, and we will have the conversation at the governors meeting in October. This is an opportunity where the MDIs, MFI members of UBA have said, fine, if capital is now being raised, there are certain services, benefits that are enjoyed by tier 1 that can now be passed on to tier 2 and 3. And the Executive Director Supervision welcomed that, and we agreed that we will use that opportunity to fast track some of these services, agent banking being one of them, before even by the time the new capital requirements take effect, much earlier. So that's a major discussion now on the agenda, and it speaks to the inclusion which Nkanji ably put, because that tier serves that segment which we badly need to reach and cover. In terms of the commitments of the industry, we are very committed. I think we have seen the benefits, the success story that the shared platform has demonstrated. It has a future, and there's convergence in shared platforms. And this is what we want to see grow, including a range of other services. And therefore, as an industry, we are committed to ensuring we are now working on a framework to be able to raise more capital, to enhance technology, to enable the platform be the rail where many other services are connected onto and solutions, so that we can really harness the full potential of a shared platform. We are working on that. There's a whole investment committee that has been put, including the transaction advisors, to support this process. There was a last question, which I can't finish this session without talking about, and that's what keeps us awake. Today, cyber fraud and the other ordinary fraud is increasing by the day, and that keeps us awake. So protecting customers, consumer protection, maintaining the integrity of such a shared platform is critical to us. And we are working on this, but always the first point starts with the customer and level of awareness. And we, like Mr. McKay said, we've had what we call DFS committee meetings with them to work jointly on a couple of controls and measures, including one being awareness and financial literacy to the customer. Then sometimes we have seen some fraudulent agents. We have now developed a shared portal where we blacklist these ones across the network, and of course work with the enforcement agencies, law enforcement agencies, to ensure that when such a thing happens, a very strong message is put across, and they know the risk of engaging yourself, particularly when you're an agent and you're a customer of the bank and we have all your records, and then you engage in fraudulent practices. So 1, customer awareness; 2, at the agent level; and 3, at the level of collaboration among ourselves and of course with the enforcement agencies, because any fraud or cyber risk undermines the otherwise good system that has a lot of benefits and enabled reach. We have taken a lot of feedback from these sessions. I think notes have been taken. For my case, I want to thank you, FSDU, GIZ, ABI, Bank of Uganda, and indeed our partner, Paul from Eclectics, and all of you who have seen us walk this journey until now. There is commitment from the industry to support this. This baby of the industry is very precious and dear to the industry. And the success story, in spite of the challenges, is something we are all proud of, so we commit to continue to support it. On behalf of the industry, on behalf of the membership of Uganda Bankers Association, I want to thank you all and thank FSDU. Good evening.
Thank you. Thank you for that, Wilbrod. That's a very great roundup of all the efforts that are being put in behind the scenes to enhance and grow what you have quite fittingly referred to as the baby of the industry, the shared agent banking system. Now, in closing, I'm going to welcome the FSD Uganda Director of Programs, Mr. Joseph Lutwama, to give us a closing address before we can formally end today's session. Joseph, you're welcome to take over the floor.
Yeah, good afternoon, everyone. Mine is really a short responsibility, just to thank everyone who has been able to attend. We thank you for honoring our invitation. We thank you for quite an engaging discussion we've had today with contribution from various members who attended. We commit as FST Uganda to continue to facilitate similar discussions on a wide range of topics related to our financial sector. And we hope that when we invite you the next time, you'll ably come so that we can together build our industry. Thank you once again, and I wish you a nice evening. Yeah. Back to you, Dana.
Thank you for that, Joseph. And now we'll try and screen the video which we had attempted to play at the beginning of the program, and guests are welcome to log out at their leisure. But thank you once again, everybody, for spending the entire afternoon with us to discuss this very important topic.
With a relatively young population and given their affinity to technology and innovation, the potential for shared agency banking in Uganda looks limitless. However, this success has not been the pandemic that led to a lockdown and slowing down of the economy hitting hard. But these challenges are in many ways also lessons to be taken into consideration for scale.
So if we look back in 2016-2017, the mobile money market in Uganda was reasonably mature. For most people, mobile money agents were and still are the most convenient point of access. It is the first shared agent banking platform on the African continent. So there was a lot of learnings for FSD Uganda as a facilitator itself. One of them being clearly understanding what is the impact that we want to achieve, how is it going to help the underserved, then understanding the various incentives of different actors in the market.
COVID has been a good lesson for everybody. I mean, it was not anticipated. It caught everybody off guard. I mean, some of the things that people have been forced to do or not do were happening for the first time. What happened with the impact that we had is that we were just starting the journey of onboarding new agents and merchants. And obviously with the government's restrictions and curfews being set up, we were literally almost grounded, because that means that agents could not open shops, as well as our field officers who are recruiting new agents could not go into the field and recruit. I would say that adoption of technology came in handy, that we were now being forced to use the existing and reach out to existing agents digitally. As I said, is opening digital account opening, allow paperless account opening. I think we have said that, we have seen that happening in Kenya and some other countries like Rwanda, and now Tanzania has taken up. And that would mean that the traditional account opening requirements are actually being reduced, what we call minimum KYC. That opens up another opportunity for those that are not maybe very literate, and use of digital biometrics for authentication instead of passwords are some of the additional ones that we have seen take up in other markets.
You know, in March, what happened was the country went into lockdown. And what that meant is there was no transportation, you couldn't, even though financial services was declared an essential service, agents still need to get to bank branches to deposit the float that they have, get electronic value, etc. It was just impossible. So agent transactions just fell down significantly. Their own agent revenues went down significantly. In a COVID environment, conversion of human behavior and pricing, because people can be very price sensitive, to digital platforms and to allow money to move without cashing out is something we need to consider for the future. For a temporary period during COVID, we had all bank to wallet, wallet to bank transactions being made free for a small amount of time. A shared platform is a long-term play. So it requires significant upfront investment from commercial banks and other players who want to ride on this platform. Till there is enough agent penetration across the country, enough reasons for people to continue using agents beyond just cash in and cash out, it will take time, and that is one of the biggest lessons learned.
With a relatively young population